Ever wonder who's really pulling the strings on the US economy? You've probably heard the name before, the Federal Reserve, but what is it exactly? And how does it affect your job, your money, your future? Let's break it down. The Federal Reserve, often just called the Fed, is the central bank of the United States. Think of it as the bank that banks go to. It was created in 1913 to make the financial system more stable, especially after a string of bank failures and economic crashes. Okay, so what does the Fed actually do? 3 big things. 1. It controls interest rates, which affects loans, credit cards, and mortgages. 2. It manages the money supply, basically how much money is flowing in the economy. 3. It oversees banks to make sure they're playing by the rules. Sounds boring? Not so fast. These decisions affect your wallet every single day. Let's say you're buying a car or a house, or even just carrying a credit card balance. If the Fed raises interest rates, borrowing money gets more expensive. That means your car loan, higher monthly payments, your mortgage, more interest over time. Even your credit card APR might go up. But if the Fed lowers rates, loans get cheaper. People spend more. The economy speeds up. Now let's talk about inflation. That annoying rise in prices. Groceries, gas, rent, everything seems more expensive, right? It's the Fed's job to keep inflation in check. Too much inflation, your paycheck doesn't stretch as far. Too little inflation, the economy could slow down or even fall into a recession. The Fed tries to find the Goldilocks zone. Not too hot, not too cold, so prices rise at a steady, manageable rate. Here's another way the Fed affects you: your job. If the Fed raises rates to fight inflation, it can slow down the economy. That might mean companies stop hiring or even lay people off. But if the Fed lowers rates to boost spending, more businesses expand and hire workers. So yes, the Fed's decisions can actually influence whether or not you have a job or how easy it is to find one. There's one more thing. If you have a savings account or a retirement fund, the Fed affects that too. Higher interest rates equals better returns on savings. Lower interest rates equals weaker returns, but usually a stronger stock market. So, whether you're saving for a rainy day or investing for the long haul, the Fed is in the background, nudging things up or down. You may not think about the Federal Reserve every day, but its decisions touch almost every part of your financial life. Your mortgage or rent, your car payment, your credit card interest, your job, your savings, the price of eggs and gas. All of it is connected to the Fed in one way or another. So the next time you hear that the Fed raised rates, or the Fed is fighting inflation, you'll know it's not just some news headline. It's something that directly affects you, your spending, your saving, and your future. Understanding how the Federal Reserve works, that's not just good to know. That's money smart. Thanks for watching. If you found this video helpful, give it a thumbs up and subscribe for more straight talk breakdowns on money, economics, and how the world really works. Drop a comment below. Has the Fed ever affected a big financial decision in your life? We'd love to hear your story. See you next time.